Welcome back. So I should begin by explaining that as a trader, you are a participant in a market.
Okay, that makes sense.
Great. So in the markets, there are two broad ways to participate and generate profits. You can either be an investor or a trader. It's important to know the difference between the two because it will help shape your expectations.
Okay, so tell us about investing in the markets.
Well, one of the main differences between investing and trading is the time frame. Investors attempt to increase their wealth over long periods of time through buying and holding a portfolio of financial instruments.
What's a portfolio? Can you tell us more about financial instruments?
Well, we've got a whole lesson on financial instruments coming up next, so I will leave that explanation for now. A portfolio, however, is what investors call their collection of assets, because investors normally work with longer-term timescales. They typically reinvest any cash that they generate into additional investments, which significantly increases their potential return through the power of compounding.
You've lost me. What's compounding?
Compounding returns is the investor's secret weapon. I'll take you through an example. Say an investor makes 10% on their capital of £10,000 in year one. Instead of spending it, they reinvest it and make 10% again in the second year, this time on a new balance of £11,000. Over time, if this process is repeated consistently, the same 10% return will generate greater amounts. In year 10, a 10% return is generating £2,358, and in year 20, the return will be £6,116, and the total capital pot will have grown nearly sixfold.
That's quite something. Are there any other differences?
Yes, there are. Investors might invest in financial instruments when they expect the instrument's price to increase over time, but they also get returns from bond interest and dividends from shares. We'll explain what these are in our next lesson. In addition, because they've purchased an asset and plan to hold it for a long period of time, they are less worried about short-term drops in price.
Oh, okay. So it's a bit like being a homeowner. You live there for a while and you're only really concerned about the long-term movements of house prices. You don't check its value every week.
Yes, that's an excellent analogy. It also becomes easier to understand if we look at how trading is characterized. Trading has a much shorter time frame than investing. Some traders participate in the markets for mere seconds. Like investors, they are looking for a return on their capital, but are looking to do so by exploiting short to medium term price changes. They are generally not looking to generate returns from dividends or interest payments from an asset.
I'm not too clear on the dividends and interest part, but like you said, we're about to cover that next.
Okay, so traders take on different risks and therefore need different risk management tools. Where an investor might spread their risk by having lots of different assets, a trader is likely to concentrate on a few markets and use risk management tools. Because of the short-term nature of trading, there's a whole set of financial services and tools out there that cater to traders. I'll introduce you to these as we move through the course.
Sounds good. I'm starting to see why traders and investors are different animals.